Geopolitical uncertainties persist, energy prices remain high, global yields rise, and market focus has been shifting from strong big technology earnings to rising borrowing costs across the globe. So it's in this challenging context that Nvidia is going to the earnings confessional today after the bell, and even strong results may not be enough to reverse the tide. So welcome to Swissquote's Daily Market Talk. It's Wednesday, 20th of May. I'm İpek Özkardeşkaya and we will talk about a lot of things again today. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So yes, it's the same story and different day again. Donald Trump yesterday first called off an attack on Iran, giving some optimism to the markets, then said that he would resume strikes if they cannot agree on a deal. NATO, on the other hand, said that they could help ships out of the Strait of Hormuz if the traffic is not established by early July. And Europeans are also considering easing some sanctions on Russian oil because they need energy. Alas, geopolitical uncertainties continue full speed. The traffic in the Strait of Hormuz is at a near standstill. The world oil reserves continue plunging at a record pace, and oil prices continue rising, fueling global inflation expectations and pushing global yields higher on rising bets that the central banks around the world will have to step in to fight price pressures, and that despite the worsening economic outlook globally. Indeed, the OECD yesterday revised its economic outlook down, factoring in the prolonged Middle East conflict and its global repercussions, starting with higher energy prices. In this context, US 30-year yield just rose to the levels last seen before the subprime crisis. The US 10-year yield approached the 4.70% mark, as the Japanese 10-year yield soared to 2.80% level. So that's also a level that was last seen before 2000. The Japanese 10-year yield consolidates near that level this morning. Now, the gap between the US and Japanese yields approached the uncomfortable zone, to say the least, around 190 basis points for the 10-year spread there, and the latter increases the risk of a carry unwind that could eventually send another shockwave across the global risk markets. And I discussed why and how in detail in yesterday's episode, so please do not hesitate to have a look at that episode if you missed that one. But to put a number, I believe that the 2.9 to 3% range for the 10-year JGB yield should eventually trigger a reverse carry trade, pulling the dollar-yen lower along with global equities. So on the FX front, well, dollar-yen is softer this morning, but not thanks to the narrowing yield differential between the US and Japanese bonds that makes the US dollar returns less appetizing, but thanks to the Japanese officials' renewed warning that, well, they would intervene if the pair went further up. So the dollar-yen is trading between its 50-day moving average on the downside and 159.10 level on the upside today. Anything higher towards the 160 level could trigger another intervention from the Japanese authorities, another short-term relief to the market, giving traders a tactical trade without, however, providing the dollar-yen a sustainable bearish shift to the downside. On the equities front, the S&P 500 was down yesterday for a third session on the back of rising yields. Nikkei is down by more than 1.64% at the time I'm talking this morning, and the Korean Kospi index retreats nearly 2% as investors focus turn from shiny technology earnings to geopolitical mess. So it's in this chaotic market environment where earnings optimism has started to lose momentum and inflation angst has started gaining momentum that Nvidia will go to the earnings confessional to announce its first quarter results today after the US closing bell. Now, expectations are high, of course, they are sky high. The company is expected to report around 79 billion US dollars in revenue in the first quarter of this year, which would be roughly 15% higher than last quarter and nearly 80% above the same quarter last year. Margins are also expected to remain exceptionally strong, around 75%. 5%, confirming that Nvidia still enjoys enormous pricing power, and that despite the massive Blackwell ramp and the rising competition among the chip makers. And what's interesting for this earnings season is that Nvidia's earnings do no longer carry the same existential weight that they carried at the very beginning of the AI craze, meaning since 2023. Back then, markets were obsessed with training AI models, with the new AI models, ChatGPT being the first one. GPUs became essential because they are incredibly efficient at handling thousands of calculations simultaneously, exactly what AI training requires. Imagine trying to get from point A to point B by simultaneously testing millions of possible paths through C, D, F, X, Y, Z, and so. So GPUs are built for that kind of parallel processing power. CPUs, on the other hand, handle straightforward computations. 1 + 1 = 2. So once the AI models are trained with GPUs, the focus increasingly shifts toward inference, which is running these trained AI models where TPUs and CPUs do a great job and memory chips are needed to store the information. That's why GPUs say more today about the raw power and evolution of AI models, while CPUs and memory chips say more about real-world AI adoption and scaling. And this growing importance of CPUs and memory chips in AI infrastructure is exactly why traditional CPU and memory chip makers like Intel, Micron, or the Korean chip makers have taken over the market's narrative recently. And that's also why Nvidia is also developing its own CPU called the Vera CPU. So today, after the bell, investors will closely focus on whether Nvidia can maintain its strong margins while scaling production and preparing the transition toward the next generation Vera Rubin platform, which is designed for the next phase of AI, massive scale inference, reasoning, and AI factories. And while the competition for running the AI models efficiently at lower cost is tough to say the least, besides traditional chip makers like AMD and Intel, well, Nvidia's biggest clients, the big technology companies like Amazon, Google, and Meta, which make up to 50% of Nvidia's revenues, are all working on their own home-cooked chips to build the most energy and the most cost-efficient chips that could do a comparable job to Nvidia's ultra-powerful and ultra-premium chips. Now, Nvidia closed near $220 per share level yesterday, some $16 lower than an all-time high level reached during the course of last week. Options markets are currently pricing in an implied move of roughly 6 to 8% on both sides following the earnings announcement, but the direction is hard to tell because expectations are now so elevated that even a solid beat from Nvidia may not trigger a euphoric rally like the ones we've seen during the early AI boom. On the contrary, even if Nvidia has little debt, well, the markets haven't baked in the rising borrowing costs that may slow down global AI adoption by slowing down investments from other firms and weigh on chip demand and revenue. And the markets haven't baked in possible Middle East-led supply chain disruptions that could eventually lead to higher costs and capacity constraints as well because of scarcity of some elements to build the chips, and that would also weigh on profits. In this context, for example, Seagate Technologies, which makes hard disk drives and data storage systems, and that exploded to the upside over the past months, fell after warning that the company may not be able to keep up with soaring demand for memory chips. So the capacity constraints will at some point start creeping in. So to me, and regardless of the strength of Nvidia's results today, three risks are piling up as big technology companies are valued for perfection. One, prospects of tighter financial conditions globally due to the Middle East war that could slow AI adoption and scale back revenue expectations. Two, capacity constraints due to supply chain disruptions that could increase costs and limit raw materials and scale back profit expectations. And three, rising competition among the AI providers that could eat into margins. And that's why even great results from Nvidia today may not prevent profit taking that would feel so healthy at the current valuations. So voila, that's the thinking. I'll leave it here and let Nvidia and investors say the last word. So this is all for today. I'm İpek Özkardeskaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after NVIDIA's results. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.